This part 4, adjustments to make profit meaningful, abiding by revenue and expense recognition. So when we look at double entry accounting and we look at the process of accounting that we've already discussed so far, we know that it goes something like this. First, we make journal entries in the general journal. Second, we post those journal entries into the general ledger so that we know where the accounts or elements stand at the end of a period. However, sometimes, because of revenue and expense recognition, we have to make some adjustments to these numbers at the end of the period. Some of those adjustments are required because of where the elements stand at the end of the period. We call those deferrals. Some of these adjustments are needed because the elements are not quite up to date or complete by the end of the period, and we have some accrual journal entries to make. So we make our regular journal entries, we post them into the ledger, and then at the end of the period, we need to make deferrals and accruals so that we can then post those into the general ledger, and from there, with up-to-date and accurate numbers, we can then make financial statements. So this picture here gives us a little bit of a window into what we call the accounting cycle. Now we've been learning a little bit about this so far, but we don't quite have all the pieces together yet. The accounting cycle essentially is the mechanics of accounting, the process of accounting for a company's performance and utilization of resources. For many companies, the steps in the cycle here, there are 10 of them in this ordering, are completed on a monthly basis. So let's look through these quickly here. You'll see that I've kind of formatted them in such a way as to show some themes or some recurring cycles. Number 1, we're going to record journal entries. Number 2, we're going to post those. Number 3, we're going to prepare an unadjusted trial balance. Now we haven't really gotten into trial balances, and that's okay. Fourth, we're going to record adjustments, accruals, and deferrals. We're going to post those adjustments and then prepare an adjusted trial balance. From there, we have the ability and the right numbers to put together financial statements. Now, again, as we talked about before, financial statements don't always go by the same names. Okay, so the income statement sometimes is called the statement of results of operations. The retained earnings statement sometimes is called the statement of stockholders' equity or changes in equity. The balance sheet can be called the statement of financial position. And the cash flow statement or the statement of cash flows usually goes by one of those two names. Once you have the financial statements prepared for the period, then we have some closing entries. We have to post the closing entries, and then we have a post-closing trial balance. So the reason that I put this together here is just to show you that there is a repetitive, you can say that, right? Repetitive, I said that. Repetitive. Okay, there's a repetitive process. Record journal entries, post journal entries, and then prepare a trial balance. So record, post, trial balance, record, post, trial balance. Then we have financial statements. Then we record, post, and do a trial balance again. That's called the accounting cycle because as soon as we end step number 10, what do? We go back to step number 1 for the next period and do it all over again. So we're going to look at adjustments primarily in this video. Revenue. This was from our fictitious company Carl's Canoes transactions in April. So a customer paid $50 in April to reserve 2 canoes for a Friday evening in May. Now we know we're going to focus on that transaction here. I've got it in pink here. And so we know that the journal entry for April was to debit cash for 50 and to credit unearned revenue, a liability, for 50 because Carl hadn't done anything yet. He had not yet earned that revenue for the month of May. It was April. May hadn't happened yet. So in his general journal, he had this entry in April, and he had a ledger balance in his unearned revenue account of $50. So what happens in May? Carl fulfills his performance obligation to the customer in May. Therefore, he has earned his revenue. Carl needs to adjust his records now. When Carl originally received cash back in April, right, he postponed, or we could say he put off, or we could say he deferred recording revenue because it hadn't been earned yet, right? He had to record revenue when it was earned according to GAAP, generally accepted accounting principles, and the revenue recognition principle, which says, FASB says, record revenue when it's earned. So, he needs to make a deferral adjustment. What's he going to do in May? He's going to debit his unearned revenue account. Okay, he's going to reduce the liability, unearned revenue, and he's going to credit service revenue for $50 to show the fact that he's earned this revenue in the month of May. That entry there, letter G, is what is called a deferral adjustment, or an adjusting entry. Okay, so that's one. Now, Carl also had some expenses in April. On April 29th, Carl pays in advance for May and June rent for $500. So, what did we do with that one? In April, he recorded prepaid rent, which is not an expense at all, right? It is an asset account, prepaid rent. Why did he do that? Well, Carl occupies the storefront he is renting. Therefore, right, in April, he had not yet incurred May and June rent. But for May, right, he now occupied the storefront for the month of May. He has incurred the cost of rent for May, and he now has to record an adjustment to his records. Sorry, I'm getting over a cold, man. Alright, so he has incurred an expense for May. Carl must now adjust his records. In April, when he paid cash for rent, he had to postpone, right, or put off or defer recording the expense until it was incurred. Why? Well, because of the expense recognition principle, right? Which says, FASB says we record expenses when incurred. Now, why do I put a woman drinking coffee here? That doesn't seem to make much sense. Well, if you think about it, you incur an expense when you absorb the benefits, right? When you experience the benefits of the thing you're trying to pay for, or the thing you're paying for. And so when Carl paid for rent in April, right? He paid in advance for May and June. He hasn't experienced the benefits of using his storefront in May until May comes, right? He doesn't experience the benefits of the storefront in June until June comes, right? And goes by. And so really, this picture of this woman drinking coffee, right? When do you experience the benefits, right, of the coffee? When you drink it, right? And so this idea, right, then drives when expenses get recorded. So in May, what do we do? We would record rent expense, not for $500, but for $250. Because when Carl paid, he paid for 2 months, $500, right, total, $250 a month. So we're going to record a debit to rent expense and a credit to prepaid rent to reduce it, right? that is your deferral adjustment for the expense. So we have rent expense then, and we have prepaid rent of $250 by the end of the month. Now, at the end of May, Carl counted his remaining supplies and determined that $130 of supplies were still on hand. Well, way back in March, Carl bought supplies, right? He bought supplies on account, which means he hadn't paid for them yet, right? But we have this entry in our journal, letter D here, supplies and accounts payable. He has a supplies account that has a balance of $150. But he goes out at the end of May and he counts the supplies he has left. And he finds out he has $130 of supplies left. So he doesn't want to continue telling people or have in his ledger account, right, that he has $150 of supplies, because he doesn't. When the benefits of an asset are used up, the cost of the asset must be expensed. So, just like we looked at in the previous example, when Carl used up the prepaid rent, he recorded rent expense. When Carl uses up supplies, he's going to record supplies expense. Excuse me. Alright, I'm back. I know my microphone's kind of noisy sometimes. Okay, so he's going to record supplies expense here of $20. And he's going to credit supplies of $20. Now, when he does that, and he posts it into the ledger, what does that do? Well, when he posts that, then he has supplies expense of $20 and supplies of $20, right? Over here. Now, what does that do to his supplies account balance? Well, $150 debit balance, less the $20 credit, he has $130 of supplies left. So he has effectively adjusted his supplies account balance. This is another form of deferral adjustment. So, need to talk about the periodicity assumption again, because this is why our adjustments are so important. In order to effectively evaluate the results of a company's operations or its financial position, investors and creditors, who are lenders, need information on a timely basis. And so we talked about how before the companies chop up their year into different periods so that they can report the results of their business. And we call this the time period assumption. So we have monthly results that a company would look at internally, probably. Externally, they're going to report to outside people on a quarterly basis. So we have 4 quarters of the year. And what we need to do is we need to be able to show the revenue earned for the first quarter versus the cost incurred for the first quarter. And the same for the second, and third, and fourth. Now, the only way we can do that is if we abide strictly by the revenue and expense recognition principles. Following the revenue recognition principle and the expense recognition principle allows us to compare a company's accomplishments, the revenue it earns during a period of time, to the costs incurred to achieve them, or the expenses, right? This type of accounting is referred to as accrual accounting. There are other forms of accounting, but this is going to be our focus in this set of videos. So adjustments, there are 2 types. Adjustments are journal entries that must be made at the end of an accounting period, month, a quarter, or a year, to ensure that revenues and expenses are reported in the right period, right? Get the right quarter or right month, and all asset and liability accounts have the correct balances at the end of the month or the end of the quarter or the year. There are 2 types of adjusting entries, and we call them deferrals and accruals. Now, here's how they're different. Let's say that we have earned revenue and incurred an expense in the second quarter of the year. If the cash that came in related to the revenue came in the first quarter, or cash went out related to the expense in the first quarter. Then we have deferral adjustments that need to be made in that second quarter to show the revenues and expenses. So, say somebody pays me in the first quarter, and I do the work in the second quarter. Well, I'm going to have to make a deferral adjustment to record the revenue in the second quarter, because I already got the money back in the first quarter. These deferrals come in two kinds: unearned revenue deferrals and prepaid expense deferrals. Now, accruals are different. Accruals, we say, well, we earn the revenue in the second quarter, but we're not going to get the money until the third quarter. Or we incur the cost in the second quarter, but we're not going to pay the cash until the third quarter. But the revenue and expense have to be recorded in the second quarter. So those are what we call accrual adjustments. These are accrued revenues and accrued expenses. Two types. So, accruals and deferrals, both adjustments, different perspective. Okay? They both need to be made because the revenue and expense must be recorded in the second quarter, right? Not in the first quarter and not in the third quarter. Otherwise, we'd be violating revenue recognition and expense recognition. So let's take a look at some others here. Customers rent 6 canoes on the last day of May. Carl sends the customer a bill requiring payment within 30 days. Well, what do? Whoops. Carl fulfills his performance obligation in May, right? They did it on the last day of May. Therefore, he has earned revenue. However, Carl's not going to get payment until June. So which month should he record revenue in? Well, again, like before, we need the revenue recognition principle. FASB says, record revenue when it's earned. So, we're going to record here debit to accounts receivable. They owe us money. And we are going to credit service revenue for $375. Again, the debit to accounts receivable shows the increase in that asset account. The credit to service revenue shows the increase in the revenue. And that is our accrual adjustment for this transaction. I think I changed the number to 15 instead of 6. Oh well, it's okay. Alright, moving forward. On the last day of May, Bunyan's Boat Repairs fixed one of Carl's canoes for $100. Bunyan's Boat Repairs requires payment within 30 days. So Carl's not going to make a cash payment until June. Should repairs and maintenance expense be recorded in May or June? Well, for us to answer this again, we would need to look at the expense recognition principle. FASB says record expenses when they're incurred. So, Carl is obligated to pay Bunyan's Boat Repairs once they have done the work. When did they do the work on Carl's boats? On one of Carl's boats here, canoes? They did it in May. And so repairs and maintenance expense has to be recorded in May. But he's not going to pay it until June, so we record a credit to accounts payable. So again, when you think about accruals, this is an accrual entry. Cash happens later. Right? When you look at deferral entries, cash happened already. Okay? So, cash happens before the expense for deferrals. Cash happens after the expense for accruals. So if we don't make these entries, right? If we don't make these adjustments, our accounting records, our general ledger, is not going to be accurate. It's not going to have the right numbers for the end of the period. Now we need to take a few minutes here to talk about a particular adjustment. We're not going to get into this in great detail here because we're going to have an entire video dedicated to this later. But the idea of depreciation. This relates to items that are long-term assets. Long-term assets such as buildings, equipment, okay? So we have buildings, we have equipment that we are going to depreciate. Now, equipment encompasses a lot of things for businesses. For Carl, he's got some storage racks for his canoes. He's got some canoes, obviously. He's got paddles. He's got probably has a software system. He has a cash register. He's got tables and chairs. If you have a computer projector, if you have a vehicle, those are all long-term assets we would categorize under equipment. So we're going to look at a particular piece of long-term asset, and that is this canoe. Okay. So the idea of depreciation, if you look it up in the dictionary, says a reduction in the value of an asset with the passage of time, due in particular to wear and tear. Now, that's what we typically think of when we think of depreciation, right? Something loses value over time, like a car, or your computer, or your cell phone. But, and this is a huge but, depreciation in accounting is about cost allocation, not about valuation. So depreciation in accounting is not about valuation. Now, depreciation being used in that way is fine. That's obviously the dictionary definition. But when we talk about depreciation in accounting, we're not talking about how the canoe here is losing value because of wear and tear. Okay, so let's look at what we are talking about. Let's say that this canoe costs $300, and we expect to use it for 6 years of time. Okay? When the benefits of an asset are used up, the cost of the asset must be expensed. Now, we talked about that with relation to prepaid rent. We use up the benefits, we record rent expense. We talked about that with relation to supplies. When we use up the supplies, we record supplies expense, right? When the benefits of the asset are used up, we expense the cost. Now, what do we do when the benefits of the equipment are used up? We record what is called depreciation expense. Now, when we talk about the benefits of the equipment, we are talking about its ability to help us generate or earn revenue. So if Carl has this canoe for 6 years, what's he going to do with it? Well, he's going to let people rent it, and he's going to then charge them for that, and that is revenue for Carl, right? So we need to look at this depreciation expense idea here, because if he's going to let people use it over the course of 6 years, then he should expense the cost of this canoe over those 6 years. So if we did it simply, we just divided it by 6, right? That's basically $50 per month per year, right? Or around $4 a month that he would have to expense the cost of his canoe. So what do? Well, we record depreciation expense for the month of $4. And every month we're going to record depreciation expense of $4. So over the course of those 6 years, we record depreciation expense here of $300. That's the cost of the equipment. Okay? That's the idea. it doesn't really have to do with it losing value. We are taking the cost, $300, and allocating it or spreading it out over the course of time that we use the asset. Okay, so depreciation in accounting, again, is a cost allocation technique. It's not a valuation method. But what's the question mark here, right? What do we credit? Okay, this presents a problem for us because of the historical cost principle. Now, the historical cost principle is the measurement principle in accounting where the dollar value of an asset on the balance sheet is based on its original cost when acquired by the company. So let's look at the supplies expense problem, right? When we recorded the use of supplies, we debited supplies expense and credited supplies because Carl no longer has the supplies. So he can credit the supplies account. The asset has actually been used up. So the historical cost of the supplies that he has, right, has changed. Now, when we get to depreciation, we have a little bit of a problem here. In the case of the equipment, the canoe, right? However, Carl still has the canoe, right? He hasn't lost a portion of the canoe. He still has the canoe. Therefore, he cannot credit equipment. It must remain accounted for at its historical cost. So, we cannot credit equipment here like we did with the supplies. We need a contra asset account. This is a new type of account for us. It's a new type of element. A contra asset account, like this one that we use for depreciation, called accumulated depreciation. Contra asset accounts, like accumulated depreciation, are assets that have a credit balance, an offset, or are contra to a particular asset. So depreciation expense and accumulated depreciation, that credit account there is a contra asset account. It is an asset account, but it has a credit balance. So it's unlike most of the other assets. It is contrary, right? Contradictory. It offsets the asset balances. So, once we've done all these adjustments, right? The prepaids, the unearned revenue, the accrued revenues and expenses, depreciation. Once we've made our adjustments, this is what our general ledger looks like for Carl. Okay? We have certain amounts excuse me, in each of the accounts. We've adjusted some of them, and some of them we didn't touch, right? The cash account in particular, up in the left-hand corner, right? We never touch cash with adjusting entries because if cash is affected by something we've done, then it's a normal journal entry. It is not an adjustment. Adjustments are only going to affect non-cash accounts. So here's our general ledger, and then we build our financial statements. So again, journal entries, posting them to the ledger. Carl's already done that. So then we make our deferrals and accruals, post those to the ledger. And once we've done that, we can build financial statements. So here's Carl's financial statements for the month ended May 31st, 2027. We see he has service revenue of $425. The new addition to our income statement is our account depreciation expense. That's the one we haven't really seen before. And so he has net income of $51. He has retained all 51 of that for this period, added to last periods, right, or previous periods. He's now at $118 and retained or kept profits, earnings. And then his balance sheet, here's where we have something new, okay? We have our current assets. Nothing's really changed there other than the balances. Under equipment, we have $300 for equipment. We are taking out depreciation of $4. It is a contra account, so it must be subtracted. Okay, $4. And then equipment, net of depreciation, or after depreciation has been subtracted, is $296. Total assets of $1951, which add up to our liabilities and our total equity, our balance sheet balances. Okay. So again, when we look at the accounting cycle, this video essentially covered the first 7 steps in what businesses do monthly to keep track of and make sure their accounts have the right balances. So record journal entries, post them, prepare an unadjusted trial balance, record adjusting journal entries, post adjusting journal entries, prepare an adjusted trial balance, and then prepare your financial statements. So we'll talk more about trial balances in a future video. Essentially what a trial balance does is it looks at your general ledger, all the debit accounts and credit accounts, adds them up to see if they have the same dollar value, because again we know debits and credits have to equal. Okay. Final 3 steps, the closing process and how that works and why we do it. So, summary. Accrual accounting, recording revenue when it is earned and recording expenses when they are incurred, subsequently requires that companies make adjusting journal entries. Their adjusting journal entries are entries made at the end of an accounting period to ensure that revenues and expenses are reported in the right period and that assets and liabilities have the correct balance adjustments and accrual adjustments. Adjusting entries help companies to abide by the periodicity or time period assumption. We get the right revenues and expenses in the right periods. And the accounting cycle is a set of steps followed in the preparation of financial statements and in keeping the books. It's referred to as the accounting cycle. This cycle is completed on a monthly basis for many companies. So, as always,